ARMs, adjustable rate mortgages, kind of the red-headed stepchild of the mortgage world. They've gotten kind of a bad rap since the 2006-2008 mortgage crash. But even if you don't hear about them too often, they are out there, and for some people, they are going to be the ticket. So let's talk about what they are. Unlike a fixed rate mortgage that carries the same interest rate through the entire length of the loan, be it 10 years or 30 years, an adjustable rate loan does exactly what the name implies. The rate can adjust. And it doesn't adjust willy-nilly. It's actually tied to something. Some banks use the US Treasury notes. Some banks use what's called the LIBOR, the London Interbank Offered Rate. But whatever your bank uses as the index, they watch that index and adjust your mortgage compared to what is happening in that index. And that could be up or down depending on what's going on in the market. There are actually 3 different types of adjustable rate mortgage. The first one is a hybrid. That's the one that you're going to hear about most of the time. And that just means that part of the time it's adjustable, but part of the time it's fixed. It's a hybrid of an adjustable rate mortgage and a fixed rate mortgage. Your loan is going to start out at a fixed rate for a certain amount of time, depending on the one that you choose. And then after that initial time period is up, then it will begin to adjust. There's an interest-only arm, and that is just as the name implies. For a set amount of time, usually like 10 years, the amount that you pay every month is interest only. But then after that 10 years is up, then you're required to pay interest and principal on the loan. And then there is a payment option arm. And again, just as the name implies, you have options as to how you want to pay your mortgage every month. And those options typically include paying principal and interest, or paying interest only. And sometimes you can pay a set amount that doesn't even cover the interest payments. Be careful about that. That's called negative amortization. It can work for you sometimes, but sometimes that can be very dangerous because that interest that you are not paying every month gets added onto the loan, and your loan is getting bigger and bigger every month. Could be a problem. Okay, so for every arm, there are 4 key components. The first is the initial introductory interest rate. That is the interest rate that you're going to be charged for whatever that introductory period is. It could be 5 years, 7 years, 10 years. Whatever that is, that's the interest rate at the beginning. The second piece of it is the index rate. The index rate is the index that I spoke of earlier, that your bank looks for a specific index, the treasury bond or the LIBOR market, whatever that thing is that it decides to tie itself to, that is the index rate. That is the rate that's going to go up and down and determine whether your mortgage is going to go up and down. The third piece of an arm is the margin rate. And the margin rate is basically the markup that the lender puts on top of that index rate. So if that index rate is 2.5 and your bank puts 2% on top of it, your interest rate is 4.5. Now, typically, it's somewhere between 2 and 3%, and it's usually 2.75. That is a common margin for an arm. So it is that index rate plus that margin that is going to give you your interest rate, or the fully indexed rate, as it is called in the business. And the last piece is the interest rate cap structure. That is the structure that dictates how your adjustable rate mortgage is going to behave as the years go by. So the first thing that you're going to see is you're going to see 2 numbers. Generally, it's like a 5/1, 7/1, 10/1. That first number, the 5, refers to the number of years that your initial interest rate is going to stay fixed. And then the second number, the 1, tells you how often after that initial period, how often your rate could change. In this example, every year. The 1 stands for every 1 year. And then the second part of that cap structure is going to be a series of 3 numbers. Let's just use the example 225. In this example, once your 5-year introductory rate is over, the first 2 stands for the number of percentage points that it could change. So ours could go up by 2% at the end of the 5 years. The second 2 stands for how many percentage points it could go up every year after that. And then that 5 at the end is a lifetime cap, so that it can't keep going up forever. In this case, it can only go up a maximum of 5 points. So using all of our example numbers, let's just say that your introductory rate is 3.5%. So after 5 years, that first 2 means that your rate could go up to, but can't go over 5.5%. And then after another year, let's just say that the mortgage rates in general are up around 8%. Well, the second 2 in our example is 2 points per year. So you can't go up more than 2 points that next year. So your cap that next year would be 7.5%. And then let's just say that mortgages out in the regular world are really horrible and they go up another 2%, so they're at 10%. Well, your mortgage can only go up 1 more percent to 8.5 because you have a lifetime cap of 5%. That's how all those little numbers work together to form the behavior of your adjustable loan mortgage. And just so you know, my very first mortgage in 1996 was a 1-5 arm. My first mortgage adjusted every year, but only for 5 years. And then after that, it was fixed. And then sometime after that, I refinanced because rates were going down. So what are some of the pros to this kind of a mortgage? Well, first of all, it's a lower interest rate. And then number 2, that lower interest rate then equals a smaller monthly payment, meaning it's easier for you to qualify, or that you can qualify for more house. Or so you could take some of your money and put more toward the principal and get it paid down quicker. And if the rates of those indexes that your bank is watching, if those rates go down, your interest rate could go down as well. However, there certainly are some cons to this kind of mortgage as well. First of all, the rates could go up. And if those rates do go up, that means that your monthly mortgage payment is going to go up as well. And can't predict the future. So if you get into a house with a payment that you can barely afford, thinking that your income is going to go up in the future, and it doesn't, you could be in trouble. So now you might be saying, hey, Carol Ann, those cons are some pretty serious cons. So when exactly is this ever really a good idea? Well, there are a few situations where it might be a good idea. Let's just say you're one of those handy dandy types and your favorite hobby is to fix up houses. So you are going and buying fixer-uppers, fixing them up, and then selling them every 2 years. If that's what you're doing and you're churning through those new houses every 2 years, then you're never going to be there long enough to have that introductory interest rate expire. Or let's just say you know that next year you're graduating with your master's degree in business and you know your company is going to give you an income boost just for having your master's. So you know that that income is going to come in. Or let's just say that your wife just told you that she's pregnant and you guys find out it's twins. Well, guess what? That 1-bedroom apartment is not going to cut it anymore. However, you know that your credit score isn't very good because of some late car payments that you had 6 years ago. But that means that those car payments are going to fall off your credit report in a year. So you just need a little extra time to get that credit score up before you apply for a conventional loan. So you could get in with an FHA arm because FHA credit requirements are lower. So you get in with an FHA arm, lower credit requirements, smaller payment, knowing that in a year your credit is going to be better, and then you can go ahead and refinance into the conventional 30-year that you wanted from the beginning. Now, ARMs are available in both conventional style and FHA style. So it is super important that you go over to this video right now and find out the difference between FHA loans and conventional loans so you can figure out which one works best for you. Thanks for watching. See you next time.